Hi, I'm Kara Murphy, and this is Money with Murphy. One of the first lessons I learned on Wall Street was simple: don't fight the Fed. That lesson, more than 2.5 decades later, still holds. But with Kevin Warsh stepping in as chair of the Federal Reserve, how the Fed shapes markets may begin to change. Now, this is not in one dramatic move, but over time and how policy is communicated, measured, and applied. 3 particular areas that will shape how the markets respond to the central bank. Start with how the Fed communicates policy. Interest rates work like a dial on the economy. Turn rates higher and growth tends to cool. Turn them lower and activity picks up. Because rates drive the economy, markets don't just react to what the Fed does, they try to anticipate what comes next. Over time, I've learned the signals themselves often matter as much as the actions. Outgoing Fed Chair Jerome Powell spent his 8 years at the helm nudging the institution towards greater transparency. He held regular press conferences, issued detailed economic forecasts, and even offered forward guidance for policy. Those data points helped investors identify where policy was headed. Warsh, though, has questioned that approach. In his view, too much guidance can actually limit flexibility. If under Warsh's watch the Fed says less, that means markets will have to infer more. That lack of clarity could mean more market volatility around policy decisions. Second, how the Federal Reserve officials measure inflation. The Fed's policy depends on how it measures that inflation. Warsh has criticized the Fed's preferred inflation measure, known as the Core Price Consumption Expenditures Index, arguing that it can miss how prices move across the economy. Instead, Warsh prefers what's called a trimmed mean approach, which eliminates outliers from measurement. At other times, this distinction may seem overly academic. Right now, though, those 2 measures are moving in opposite directions as higher oil prices filter unevenly through the data. If Warsh has his way, the trimmed measure can point to lower inflation and in turn support lower interest rates. Third, the Fed may change how it approaches its balance sheet. Rates aren't the only lever that the Fed has. They can also buy and sell bonds, and sometimes a lot. During the COVID pandemic and the global financial crisis, the Fed didn't just lower rates, it bought trillions of dollars in bonds, expanding its balance sheet from less than $1 trillion to nearly $9 trillion at its peak. That level still sits near $7 trillion today, far above pre-crisis norms. Warsh has been clear, these tools should be used in crisis and then unwound more quickly afterward. A faster drawdown would remove a layer of support that investors have grown used to. So what does this mean for investors? This shift isn't about a single policy change. Instead, under Warsh's leadership, the Fed may communicate less, measure inflation differently, and rely less on its balance sheet over time. But it's helpful to keep in mind that the central bank itself still moves deliberately. Decisions run through a committee supported by deep research and a strong bias towards continuity. While change may be coming, investors would do well to continue to heed the words, "Don't fight the Fed." Until next time, invest wisely and live richly.